but financials and information technology, your top sector holdings. So why are those enabling you to get the performance that we just spoke about?
Well, what I would say is what our focus is, we try to be a little bit different than your ordinary income fund. So we provide a monthly dividend to our investors. Our overall yield's about 3.4% versus the S&P 500 around 2%. However, where we're a little bit different is, as you mentioned, we're trying to diversify ourselves.
Right.
So what we're doing is we're looking for more lower payout type companies that we think have solid businesses that can grow their dividend payouts over time, either through dividend payouts or by growing their earnings.
So that would explain the move into technology, I guess.
So it's a little bit more growth oriented
Right.
than your typical income fund.
You do hold Apple. When did you buy Apple? Was it right when the company started paying dividends, or did you buy ahead of that?
We did. We bought it about when they started paying dividends.
Okay.
We still believe in the Apple story. We think
Did
the
you add to
valuation
your
is cheap.
position?
We have added to our position earlier this year. We still believe the second half, it's a product cycle story now, and we think you're going to have a nice product cycle in the second half of the year.
You also have in your top 10 Qualcomm and Agilent. So
Yes.
this is part of the outsized growth theme and potentially higher dividends down the line?
Definitely. Both Agilent, for example, has spent the last few years cleaning up its business and spinning off some non-performing assets. Last year initiated a dividend for the first time, and this year they increased the dividend and actually just announced a share buyback as well, so they're becoming much more shareholder friendly.
You also hold some retailers in the top 10, which I found interesting. Walgreens, Dick's Sporting Goods, the other
Yes.
one. What is it about those two names that are attractive to you in the retail space, which can be a tough space, quite honestly?
Yes. Well, I think with Walgreens, what we liked about Walgreens is, especially for 2013, you're up against easy comparisons, because last year they had a dispute with Express Scripts, which hurts their monthly sales comparisons. This year, you anniversary that, and they also last year made an acquisition of a company called Boots over in the UK, which they should start to recognize synergies this year from that acquisition. And earlier this year, they signed a deal with AmerisourceBergen for a distribution agreement on some of their generic and branded drugs.
And Dick's Sporting Goods?
And Dick's Sporting Goods is much more the growth retailer that we have in there. We like Dick's Sporting Goods because right now, athletic apparel is what we're in the strength of the apparel cycle. And for this point, we like Nike, we like Adidas, and the best way to play the overall theme is with Dick's Sporting Goods, which is one of the few national sports apparel retailers.
Now, in your commentary at the end of the first quarter, you were a bit cautious about sluggish economy. So are you feeling better at all about how the economies are looking?
I would say over the overall global macro, we are still a bit hesitant. We have, in the fund, we've actually carried a decent cash position through the beginning of the year, which has offset some of the growth that we had, but still allowed us to overall perform in line with the market. So I think as we look toward the back half of the year, we're still a bit cautious.
And what are you cautious about?
Well, I think there's a lot going on. Within the U.S., we really haven't seen jobs significantly pick up. With outside of the U.S. and Europe, we still don't know exactly what's going to happen with the entire debt situation throughout the continent.
So does that put some of these companies accelerating their dividends at risk, right? I mean, are you worried about that? If they're not going to really perform on the earnings front, they're not going to be able to grow their earnings.
Well, I would say at Alpine we do global funds. So we have the ability to go global, but if we're uncertain, we also have the ability to stay domestically. So right now, for the Accelerating Dividend Fund, a majority of our assets are in the U.S., where we feel that we've got a solid base of companies that should be able to continue to increase those payouts over time.
Are you thinking about or repositioning the portfolio in any way? We have seen interest rates start to rise in the last couple of weeks, and there's a lot more chatter about what the Fed is going to do. So how, as a PM, are you strategically thinking about that with your own holdings?
Well, I think that's one of the good things about how we differentiate ourselves. Since we're not in your typical, say, utilities or your typical income fund type names, we're able to weather that a little bit better. So as we've seen in the last few weeks, as interest rates have risen, utilities, for example, as a sector, have come down. We've been able to perform at least in line with the market over the first period of the year, mainly due to the fact that we've got the diversification that we do have.